How much are you paying for your online share trades? $32.95, $19.95, or just $15 with Bell Direct. Bell Direct. Better value, pure and simple.
Thanks for joining us on Market Day. Well, global financial regulators have agreed on new banking rules aimed at reining in the risk blamed for triggering the credit crunch. Banks will be forced to hold more and safer kinds of capital to offset the risks they take, lending money and trading securities. Some banks are arguing the new rules will hurt their profitability and force them to reduce the lending that fuels economic growth. Joining us to discuss the potential impact of the new rules on Aussie banks is KPMG partner Paul Lichtenstein. And of course our guest host with us here in the studio, Steve Johnson from Intelligent Investor, also with us. Paul, if we could just start with you. Just firstly, your thoughts on the agreement reached by the Basel III committee, the compromise reached over the weekend.
Well, I think it's a very positive agreement. It's certainly going a long way to increase the stability of the financial sector, which is really what it's all about. So certainly a compromise between a range of regulators, as you would expect in an international forum such as the Basel Committee, but generally very positive.
Just looking at the terms of the agreement, how is it going to be different? Obviously, the definition of capital there, is that something key in this?
Well, certainly there's a range of factors. The primary one is the increase in the level of capital and the quality of that capital that needs to be maintained by banks. That goes to confirm the stability in the financial sector and make banks a little bit more secure. In terms of the impact on Australia, it is less significant than in many other countries. And the key reason for that is the Australian banks are well placed in terms of capital and have come through the global financial crisis in a stronger position than many of the international banks.
Looking at this, APRA now needs to go through the decision and work out how they're going to implement it. There's talk it could take the next year. I mean, is that the sort of time frame you're expecting, and what are your expectations from APRA?
Yeah, absolutely. It is quite a long process. Now, it's worth noting that the Basel Committee puts out guidelines for international regulators, and it's up to the individual countries to determine how to implement that. So in the case of Australia, APRA needs to take those guidelines and turn them into prudential standards in Australia. That process does take time. It involves consultation with the banks and ensuring that any rules that are imposed on Australia is adequate for the local market. So it will take some time. The expectation is towards the end of next year that the standards will be out there. And there is a transition period of quite a number of years before some of these regulations become enforceable.
Paul, the banks in Australia here seem to have plenty of capital to deal with these issues, but the actual types of capital, there's a shortage in the Australian market, is my understanding, and they also need to match their maturity. So if you've got long-term loans out there, you need to have long-term funding as well. How long do they actually have to comply with these regulations?
Well, there's a phased approach for a number of the requirements, starting from 2013, but through all the way to 2019. The particular issues, though, are more around liquidity in Australia and having sufficient liquid assets to meet the liquidity requirements. In Australia, there is, well, we're in a fortunate position of having a shortage of Australian government debt. Therefore, there may not be sufficient Australian government bonds to go around to meet some of the liquidity requirements. There's a range of measures, though, that can be taken to counter that, and we'd expect APRA to provide some guidance on that, such as looking at using state government bonds, public sector entities, potential foreign entity bonds if they meet the appropriate credit standards.
So APRA has a choice to deal with these rules and have a little bit of flexibility, does it, about the Australian banks and what they actually need to comply with?
Absolutely. APRA has clearly stated that they will comply with the general requirements, as all countries that are members of the Basel Committee will. However, there's national discretions where APRA can interpret the rules that are appropriate for Australia. They certainly have done that through the Basel II process, and any rules need to be reflective of the environment in which they operate. So certainly APRA will interpret those elements that require adjustment for Australia.
Paul, some of the banks offshore, global banks, have been arguing that these kind of measures are going to curb lending at a time when it's needed for global growth. I mean, is this going to be an issue too here in Australia?
I don't see that as a major concern. The key reason for that is the Australian banks are currently well capitalised. So the new rules do not necessarily impose significant additional stringent requirements on them. They are well capitalised. They are currently travelling fairly well and have no real capital constraints in terms of ongoing lending. So I don't see that as a major concern. What is more of a concern is more the impact on the liquidity rule changes. Holding additional liquid assets does increase the funding costs for banks, and there is the risk that that will be passed on to consumers.
I think even in the US they have this problem that the banks aren't actually lending, but it's got nothing to do with the capital requirements that are placed on them. It's still around the fact that everyone's petrified about actually getting out there and lending money. So they have this problem, and it's not a result of the Basel III regulations. It's a problem that's built up over the past few years. So there's all this cash sitting there that they actually can't get out into the economy at the moment, and that's one of the main problems they face over there in the US.
Steve, do you have any banks in your fund? I mean, what's your thoughts now, given Basel III?
Look, I think this is a bit of a non-event for the Australian banking sector. As we've already discussed, they're very well capitalised, and these new requirements are not going to require them to raise any new absolute capital. They may have to change the types of funding that they've got, but I don't think it's going to be a big issue for them. I do think there are some big issues for the Australian banks. I think they're reasonably priced. I don't own any at the moment, but I think they're reasonably priced. But the two big issues that they face are that they are almost completely dependent on offshore funding to fund their books, and that's because we have a shortage of domestic savings here in Australia. And the second one is that I think that the residential housing market has been a massive driver of their profitability over the past 20 years, basically. Now, even if we don't have a correction in that market, I just can't see it continuing to grow the way it has grown in the past, and I think there is a risk of a correction. So those are the two things that could have a big impact on the Australian banks.
Paul, what are your thoughts on those comments from Steve about the issues facing the Australian banks here?
Well, certainly the Australian banks are travelling quite well at the moment. I can't really speculate in terms of the mortgage market and where that's heading. We can't forget that despite any of the regulatory changes or issues impacting banks, it all comes down to credit quality. And ultimately, banks are not going to lend if the credit quality is not there. So it's a broader economic issue rather than simply looking at regulatory changes and some of the specific rules that are changing.
Paul, just on dividends as well, payouts by the banks, I mean, do you see that being impacted by these new rules?
That is one of the requirements in terms of looking at dividend payouts relative to capital holdings and restricting some of those payouts. Again, in the case of Australia, the banks are very well capitalised, so it's not really touching those boundaries at this point. I don't see that changing in the short term, but again, who knows where things are heading in the next 5 to 10 years. But it shouldn't be too much of a concern currently for investors.
And Paul, I also understand that there are some rules about trying to deal with the cyclicality in the banking industry, so you actually have to hold more capital at times when the regulators deem it to be buoyant. Now, there's not much clarity around this at the moment, but would we be perceived here in Australia to be in a buoyant market at the moment where the banks would have to hold more capital than the base requirements, or is that something that hasn't been clarified yet?
Well, it hasn't been clarified yet, and it still remains to be seen whether APRA do implement that requirement or how they in fact do it. The counter-cyclical buffer is certainly a hot topic at the moment. I'm not so sure we're in a buoyant position just yet. Fairly stable, but it remains to be seen how the market reacts to that as well, in terms of holding additional capital when the market is good. Contrary to that, then, reducing capital in times of stress. That might not be accepted quite as well.
So, Paul, just your full thoughts on how you think the market is going to respond to this?
Well, generally, I think it's pretty positive. On a global basis, the rules are, there's clarity. There's been a lot of uncertainty for a long time, and it's a real positive to have that clarity. In Australia, I don't think a significant impact on the banks just at this point, and that's because the Australian banks are well placed and well capitalised.
Paul, it's been great to speak to you today about these. Thank you so much for joining us on the program.
Thank you, my pleasure.
Paul Lichtenstein there from KPMG. Steve, plenty more to ask you about too. We're just going to take a very quick break here on Market Day. Then after that, more analysis on Leighton's changing of the guard. Plus, we'll discuss where to find the best investment opportunities on the Aussie market.